Imagine a world where New York State, one of the most influential financial players on the global stage, decided to pull its massive $270 billion pension fund out of Wall Street. It sounds radical, doesn't it? Yet that's exactly what Drew Warshaw, a candidate for New York State comptroller, is proposing. If elected, Warshaw plans to shift a significant portion of the state's investments away from Wall Street firms and into ultra-cheap passive index funds. But why is this such a big deal? The New York State and local retirement system has poured over $90 billion into private equity, private credit, real estate, and other complex assets, all promising high returns to keep up with the increasing demands of retirees. However, these high returns come at a steep price, high fees. This raises a critical question that isn't just relevant to New York, but to hundreds of other state and local pension funds, charitable endowments, universities, and government funds around the globe. Are these high-priced managers worth the hefty fees they charge? Historically, alternative investments have provided a competitive edge, but recent trends suggest otherwise. With the explosive growth of big tech stocks like Microsoft and Nvidia, and with alternative managers now targeting smaller investors, there are legitimate concerns about whether these alternative investments can continue to outperform the broader market. Warshaw, for his part, isn't convinced. In an interview, he described his starting position as deeply skeptical and believes that alternative asset classes must prove their value. According to data from the Boston College Center for Retirement Research, the NYSLRS has only met its assumed rate of return in 9 out of the past 15 years. But not everyone is ready to write off Wall Street. Brad Lander, New York City's comptroller, initially approached private equity with skepticism, but ended up increasing the city's pension fund's exposure to private markets after being convinced by his team. It's a debate that's both contentious and necessary, with passionate arguments on both sides. So what do you think? Should New York's pension fund abandon Wall Street? Or is there value in sticking with what has historically worked? Let's hear your thoughts in the comments. And this is the part most people miss. The decision isn't just about numbers and returns. It's about the future of our financial system and how we want to shape it. So, will New York take the leap? Or will it stay the course? The choice is as controversial as it is critical.